Maria believed she was being responsible. At 26, when she landed her first serious job, she scheduled a meeting with a financial advisor because that's what financially mature adults are supposed to do. Don't guess, don't gamble, hire a professional. The advisor was polished and reassuring. He talked about diversification, risk tolerance, and long-term growth. He showed her charts that steadily climbed upward over decades. He selected a portfolio of actively managed mutual funds run by experts who, he said, dedicated their lives to studying the market. Maria felt safe. She set up automatic contributions of $500 per month and stopped thinking about it. 20 years later, at 46, she logged into her account after barely checking it for years. She had contributed $120,000 in total. Her account balance was $287,000. That seemed solid. She had more than doubled her money. She felt proud of her discipline. Then her nephew, fresh out of a finance program, asked one question that changed everything. What are you paying in fees? Maria didn't know. The fees she never felt. They dug into the account statements. The advisor charged 1% annually. The mutual funds averaged around 0.8% in expense ratios. There were additional small administrative costs layered in. Altogether, Maria was paying roughly 1.9% per year on her entire portfolio. That number sounded harmless. Over 20 years, she had paid about $73,000 directly in fees, but that wasn't the real damage. If she had invested the same $500 per month into a low-cost index fund charging 0.03% with no advisory fee, her portfolio would have grown to roughly $392,000 instead of $287,000. She didn't just lose $73,000. She lost more than $100,000 when you factor in compounding. The fees plus the growth those fees would have earned had they remained invested. She paid more in fees than she invested in her first decade, and she never once felt the money leave. Why investment fees are so dangerous. Investment fees don't feel like payments. When you buy a car or pay rent, you see the money leave your account. With investments, fees are quietly deducted from returns before you ever see them. Your statement might show a 7% gain for the year. What it doesn't clearly emphasize is that the market may have returned 8% and 1% disappeared before it reached you. You don't experience that 1% as a loss. You simply experience slightly smaller growth and assume that's normal. This structure is intentional. The industry learned long ago that percentage-based fees deducted invisibly are easier to tolerate than visible bills. A 1% fee sounds small. On a $500,000 portfolio, that's $5,000 per year, every year, for the rest of your life. And as your account grows, the fee grows with it. The layers of extraction. Most investors don't realize how many layers exist. Mutual funds charge expense ratios annually regardless of performance. Some funds include front-end or back-end sales loads that take a percentage before or after you invest. Many include 12b-1 fees, which are marketing costs embedded in the fund. You're effectively paying to advertise the fund to other investors. Then comes the advisory layer. A 1% advisory fee sounds reasonable until you understand it's charged every year on your total balance. Add advisor fees, fund expense ratios, trading costs, and platform charges together, and 2% per year isn't unusual. 2% feels insignificant in a single year. Over decades, it compounds into massive wealth transfer. The 40-year math most advisors avoid. Imagine two investors starting at age 25. Both contribute $500 per month for 40 years. Both experience an 8% gross annual return. Investor A pays 2% in total fees, netting 6%. Investor B pays 0.1%, netting 7.9%. After 40 years, Investor A ends with about $1 million. Investor B ends around $1.7 million. Same contributions, same market performance. Nearly $700,000 difference created by fees alone. That difference never feels dramatic in any single year. In year 1, it's barely noticeable. In year 10, it's modest. In year 40, it's life-altering. Fees are a slow leak, not a sudden crash. By the time you notice the damage, compounding has already done its work. Paying more for worse performance. Many investors assume higher fees mean better results. After all, expertise should outperform, right? Long-term performance data tells a different story. Over 10 to 15-year periods, the majority of actively managed funds underperform broad market indices, not occasionally, consistently, after fees. You're often paying more for statistically worse outcomes. But ETFs are cheap now. Exchange-traded funds have dramatically reduced costs in recent years. Many index ETFs charge as little as 0.03% annually. That's a huge improvement over traditional mutual funds. But costs often creep back in through advisory overlays, robo-advisor fees, or platform charges. A 0.03% ETF wrapped inside a 1% advisory structure is no longer low cost. The product looks modern, the extraction remains. The packaging changes, the math doesn't. Why rarely you see this comparison? Most advisors won't begin a relationship by showing you a 40-year side-by-side compounding chart comparing 2% versus near zero fees. Not because it's difficult to calculate, but because it reframes the entire conversation. Instead, discussions focus on diversification, risk profiles, and quarterly updates. But rarely is lifetime fee drag presented in a way that makes the cost emotionally real. Once you see it clearly, it becomes difficult to ignore. The hard truth. Maria wasn't irresponsible. She trusted professionals. She followed what she believed was the safe path. And that trust quietly costs her 6 figures in future wealth. This doesn't mean all financial advice is useless. Complex tax planning, estate structuring, and behavioral coaching during downturns can be valuable. But paying a percentage of your assets every year for basic fund selection often doesn't justify the lifetime cost. Sometimes paying for advice by the hour or by project makes more sense than surrendering a percentage of your growing net worth indefinitely. The question you should ask. The most powerful step you can take is simple. Know exactly what you're paying. Add up advisory fees, expense ratios, and all underlying costs. Then run the long-term math. Project it over 30 or 40 years. Because investing isn't only about chasing higher returns, it's about minimizing guaranteed losses. Market performance is uncertain. Fees are not. Maria doubled her money, but she could have nearly tripled it. The difference wasn't timing. It wasn't intelligence. It wasn't luck. It was cost. And once you understand that, you stop asking only how much you're earning, you start asking how much you're quietly giving away.